Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7:48 Mountain Time on Monday morning, June 23rd. Getting this out a little bit late because we flew back from New York and New Jersey yesterday out of Newark. And wasn't entirely their fault. Weather and thunderstorms in Pennsylvania, and a crazy person on the flight who insisted that the flight attendants were keeping her hostage by not letting her off the flight. So anyway, as a side note, we did spend the week in New York City. We had a couple of media appearances. You may have caught us on CNBC and Fox Business. We had meetings with some very interesting clients, and titled our note this week, Transitory Purgatory. It was kind of poking fun at the Fed for being in purgatory because of the policy mistakes they made back in 2021, not understanding how the inflation process truly works, the role of government spending and triggering the goods inflation and then services inflation. They're getting it all wrong around trade and immigration policy and all today. So that notwithstanding, the bulk of the note was really about the growth trajectory, and we titled that Still Detoxing. The point here is, as we moved through the last few months, markets got very fixated on trade policy. We said all along that the other policies could prove to be more monumental over time, and growth is clearly slowing. And this is going to be a major theme, particularly as we get into earnings season in a little less than a month's time. So consumer spending ran at nearly 4% in the second half of last year. We're running at less than 1.5% with the first half of the year almost complete. Government spending was much slower in the first quarter. It'll likely be slower in the second quarter. It's still too high, but nonetheless, government spending has decelerated. The labor market is not solid, as the Fed describes it. It's had a very weak foundation for some time. And we think when we get the first estimate of the annual benchmark revision in early August, we'll have the fourth consecutive year where payrolls will be revised significantly lower. The housing market is having another leg lower. Last week, we get the NAHB Home Builders Survey. We got housing starts numbers. Again, the housing market is decidedly weak. And this brings us to earnings season. So this is critical in our view. There's two sectors clearly benefiting from the artificial intelligence investment boom. Those would be tech and communication services. Those two sectors, earnings are expected to contract by 1% on a paltry 2.25% revenue growth. Margins are under pressure in the consumer-facing sectors. Chair Powell said, someone's going to have to pay for these tariffs. Our view is it ain't going to be Joe's six-pack, but the companies that sell to him are going to get hurt by the margin pressures. There just is no price elasticity of demand. They can't pass prices through, and it's going to cost them. So we are underweight those sectors and remain so. But that earnings season could prove to be a macro event. Very weak earnings, in that vicinity are likely to be an issue for the broad equity market, causing some kind of a pullback and perhaps triggering a rally in the back end of the Treasury market as well. We think the storm there has passed for now. We'll see the Senate bill this week. That may get a few people excited. We have this is belly week, 69 billion of twos, 70 billion of fives, and 44 billion of sevens being issued by the Treasury. But we do think that there's scope for a rally as we go through this growth slowdown, continued detoxing process. So we think the Fed is getting all this wrong. So does Governor Waller. I think they're misreading inflation. We wrote all about that the previous week. We won't reiterate those arguments. The Fed clearly looks at the totality of the policies and sees lower growth in 25 and 26, higher unemployment in 25 and 26, and higher inflation in 25 and 26. So they are clearly not supportive of the president's policies. I suppose they would have much preferred President Biden's government spending blowout, but the Fed is in our view wrong about this and clouded by their ideological homogeneity of new Keynesian economic thought. not to be too obtuse about all this. There will be some very interesting developments on the bank regulatory side. We'll write more about that this week. We had it in the note. And as we said, we're very solid with our equity positioning right now, being underweight the consumer sectors, being overweight beneficiaries of what we think will be a capital spending rebound in the second half of the year. We're going to get some more regional Fed surveys this week. Last week we get the Empire and Philly Fed surveys. And we'll find out more about the Senate version of 1 BBBA. So it's going to be a very interesting week. Good luck, everyone. Have a good week. And if you're not already considering becoming a subscriber, we'd love you to do so. If you need a trial to look at the product, send us an email. We're happy to do that for you. Thank you. Have a good week, everyone.